G'day there, Wealth Press traders, viewers, subscribers, and investors. It's time for another Monday morning roundtable, and I'm joined by my usual guests, Jeff Yasteen, Jeff Zananiri, Adam Sarhan, and Roger Scott. Gentlemen, welcome.
Morning. Thank you for having us.
Good morning.
Well, gentlemen, tomorrow is the day that power transitions from Republican to Democrat, from Trump to Biden, and already there's some nervousness in the marketplace about Biden's regulatory approach. And he has made a couple of choices in the consumer financial sector that have got Wall Street on edge. Should we be nervous? Jeff Zananiri, I'm going to start with you.
Yeah, we should be nervous. We know what this playbook looks like. We know what happens. I mean, right now we're still in this honeymoon period and everyone's like, it's going to be awesome. Everything's going to be great, which for the most part, it probably will be. But these guys like regulations. They like to have a few more referees on the field than we're used to. And, that acts as kind of like a wet blanket on things, in my opinion, when it comes to finance, when it comes to Wall Street. More taxes for transactions are not a good thing. More regulations for how banks can use the capital that they've been assigned is not a good thing. But I'm interested really to hear what Janet Yellen has to say today, because she's for the lack of a better word, she's a big swinger out there, and what she wants to do and what she says matters. She's going to be the Secretary of the Treasury. And so if she's dovish Janet that everyone expects, maybe she'll sign off on $5 trillion extra dollars in spending. Maybe she signs on to MMT infinity. Maybe she wants the Fed to spend $100 billion a month in asset purchases. These are all things we've speculated about, but we want to hear it from the horse's mouth.
Sure. Roger, do you concur with Jeff? Do you see opportunity in this landscape, or are you more fearful than optimistic?
Well, I like how Jeff coined the swinging.
I stopped short. As Costanza would say. I stopped short, just short.
Even G-rated here.
I don't know if I could focus anything beyond that, but no, all jokes aside, I completely agree with Jeff. I think the market right now has bigger fish to fry than trying to foresee what Biden is going to do. I think that's going to I think that's going to be largely muted by or overshadowed, if you will, by the current COVID and the restructuring and a few things. I think we're going to see more of that and the impact of that as we gain a little more traction. But I guess that's putting it in the same way as Jeff said, that we're in a honeymoon stage right now. I guess I'm just saying the same thing in a different way. I think the market is set up. I believe what happened last February, March, April, and May, and all of the stimulus that's been given into the market is shaping the market more than policy at this time. I think we have to actually look at what's going under the hood. We have to look at earnings that just started with bank stocks. And I also do believe that Yellen will be a bigger impact than the president, because we kind of know what to expect with her. We know what she's capable of. We know her propensities. So I think yes, we are going to see the impact of the new administration. No, we're not going to see it fairly soon. We're going to see it further than sooner. I think in the next several months, maybe the next 2 quarters, the market is going to be shaped by the COVID, the retail sales, the GDP, and stimulus. And then as things settle down, as the honeymoon stage kind of dissipates, I think then we're going to kind of get a better feel for what Biden will do. And also, and I'll end here, I think Biden is I think he's more sensitive than typical in making too many changes and making too much noise in light of the environment, in light of the vulnerability, or in light of the vulnerable environment that we have in front of us.
Mm-hmm. All right, Jeff Yasteen, what's your take on the situation, and where are the opportunities versus the threats?
Yeah, regarding regulation, obviously there will be more, and probably across a fairly wide degree of industry. And this is just something Democratic administrations do. It's part of their priorities. in terms of policies, protecting people, et cetera. But of course, it also adds cost, and trying to define where one or the other should take precedence, of course, is that's what politics is all about. And for example, regarding like banks, my message here would be basically to not try to parse this too finely in terms of, oh, if they're going to add an extra set of regulations, that's going to really hurt banks with a capital H. It's not going to. The key here is interest rates. And for instance, I started talking about banks here back in October and early November. And since then, like the worst of them, like Wells Fargo, is up like more than 50%. So I think that's just the beginning of the move for this entire sector, simply because I think we're at an inflection point over the last 5-6 months, where interest rates, which have now gone from like 0.5% to 1.1%, which sounds like nothing, but of course it's really a doubling in interest rates as measured by the 10-year Treasury note. I think this is just the beginning, and when you add in the stimulus and all the other amounts of money that are going to be printed up and spent, I think, and add in also the thing about oil prices, which I think are also continuing to rise. They're almost at $53 today as we speak. That's what's going to be driving things, is inflation and interest rates. And there are going to be winners and losers. The winners, certainly banks, old school energy companies, as well as a lot of the alternative energy plays as well.
Mm-hmm. Okay. And Adam, what is your take on this situation?
Yeah, my thought process is very simple. There's one primary, I always look at risk and reward. There's one big elephant in the room from a risk standpoint that could derail or destabilize this easy money train that we've seen since the COVID March low of 2020, and that's inflation. So the one word on my mind, and the one big thing, Jeff had mentioned it earlier, is that I'm seeing a ton of inflation occurring beneath the surface from food and energy, which is what they call core inflation. If you look at soybean prices, SOYB is an ETF that tracks it, or corn, CORN is another ETF that tracks corn prices, or DBA, an ETF that tracks agriculture in general. You've seen massive moves in these areas, and these are big commodities. And you can go on wheat and oats and so on and so forth. And then that's the food. And then when you look at the energy prices have skyrocketed recently. Oil, like Wyatt just mentioned, is going up and has gone up a lot in the last several months. RBOB gasoline, the gas at the pump, I don't know if anybody realizes or not, but it's gone up significantly on a percent basis, and it's continuing to rise. And then so is nat gas and heating oil, so on and so forth. So food and energy for me are the big concerns here, because the Fed changed their stance late last year and said, hey, we want to have inflation around 2%, not at 2%, but around, which means what? It can go above 2% and they'll keep rates near zero. So that gives them a lot more runway before they have to raise rates. But if inflation starts picking up, which is what the Fed wants to happen, just listen to the Fed. This is not rocket science. And we're seeing food and energy prices already take off. What happens if inflation starts to take off and kick in, and then all of a sudden we start getting big time inflation here in the country? That's not going to bode well for Main Street, especially lower and middle income Americans that are already struggling as it is, let alone if they have to see a big 20 or 30% increase in food and energy. So for me, having a big time run in inflation, especially with the signs starting to happen now, could be a massive shift in this easy money environment that we find ourselves in.
Interesting. Okay, so then are there opportunities outside of these sort of macro sectors that that constitute an extraordinary opportunity during the transition period? And I'm looking for, like, for example, China is not off the hook, as it were, just because Trump's riding into the sunset. As Biden has indicated, he's not going to be in any hurry to diffuse the trade war that Trump started, because there are issues with China that must be addressed for the longer term, regardless of the administration. Other situations include Russia and its sort of continuous interference in American communications, politics, and computer systems. So all of these macro geopolitical things are going to have various sort of opportunities and implications for different markets and different subsectors of the market, particularly in telecommunications. Jeff Z, do you see any subsector like that, or sort of specialized sectors that might be a play during this transition period where there's so much uncertainty on the geopolitical stage?
Listen, everyone is, I'm going to say two things. So number one, it's become kind of a fool's game guessing how the macro picture is going to shake out. So I think when there's so much erratic behavior, it's best to try to not like get it all right. But I will say this about the China specifically. Everyone is so focused on the US side of Chinese relations. And it's really not just a Chinese US situation. It's China and how they deal with the entire Western world. And I think one thing that I don't hear enough people talking about is China's propensity to put the kibosh on their own companies like Alibaba, like Jack Ma. They don't need Joe Biden or Donald Trump or anyone else to stop their own momentum. They want to do it themselves. And that, for me, is an alarm bell. They are looking at their own companies and saying, you are too big. You are too important. You are superseding the state. And they don't like that. They've reached the end game of what they're willing to see from capitalism. And that's kind of scary for me. That's one thing I want to say. But one sector I'm looking at that is not geopolitical is cannabis. That's a sector that has been trading on its own, which I love right now, because with all this noise, with all this speculation about what policy is going to be, there's one thing that we know. We've had already a boom and bust. So we're seeing the birth of Cannabis 2.0, which is always a really exciting time to get into a sector. After you've had the early euphoria, and then you've had the letdown and the disappointment and the huge shakeout, what comes out of the ashes is often much bigger, much better, much more robust, and much more ironclad and built for the long term. So cannabis is a sector I'd be focused on precisely because I don't want to predict how macro is going to shake out.
Wow, that warms the cockles of my heart to hear you say that, Jeff, because cannabis is a sector in which we've spent a lot of time, and we're on the brink of a third wave here, in my opinion. However, Roger, do you have great expectations for the cannabis industry as well?
Oh, absolutely. I sure do. Look, this administration is doing a 180 of what the Trump administration did. We now have a Senate and a House that's both Democratic, a president that's fairly liberal. There's a good chance that marijuana is going to be legalized on a federal basis over the next 2 years. If not, various states, even Texas is I mean, Texas, who would have thought Texas would legalize marijuana? They're creating a medical program. The industry is on the up and up. There's absolutely no question. And also the sentiment, the way people look at it has completely changed, which is big. If you looked at marijuana 15, 20 years ago, it was a big no-no. Now it's just like cigarettes or tobacco or alcohol. So the sentiment towards it has changed substantially. Another sector that I like, and I agree with Jeff, we don't need to look at the macro view to determine what to invest in. We could look at things that are a lot closer to us. Like, for example, every time the administration changes from a Republican to a Democratic administration over the last 70 years, gun sales have gone up substantially over the next 2 quarters. Why do gun sales go up? Because people who own guns and love guns start believing that Democrats are going to take their rights to guns or restrict their rights to guns, and they start going on a shopping spree to accumulate as much of these weapons as possible. And now, with all of this friction going on and the division we're seeing in America, the situation is at its peak. We've never been more divided as a country. Gun sales are on the rise right now, ladies and gentlemen. And there's no reason to really second guess what will happen with bank stocks or airline stocks or cruise ship stocks. Go with where the money is. Go with the sector that cyclically goes up when there's a change of administration. And right now, I see no better place than healthcare, evergreen energy, lithium, gun sales, and pot stocks. And I know they all don't kind of go together, but in a financial story, they actually make a lot of sense right now.
Mm-hmm. So Jeff Yasteen, do you have any other things to add to those sort of sectors, or are you enthused about cannabis?
Yeah, I am enthused about cannabis. I forget, like a day or two after the Georgia Senate races had concluded, I did a video of my three favorite cannabis stocks. And, since then, one of them, which was Afria, is up like 40%. And the other two, Trulieve and Canopy, are doing nicely as well. I think that whole sector is definitely a place that has now sort of reached that maturity level. And I think with the conclusion of what's happened with Congress and Biden and the presidency, we're going to see, I think, the reform, and we're going to see more of a new legalization in terms of federal banking laws, basically what I'm trying to say here, to make it easier for these companies to move their money around and do their investments where they need to do. The other thing about cannabis that I really like here is that there's much more of a focus recently, as the companies talked about, on cash flow and on getting towards profitability. And some of them are profitable now already, which wasn't the case for a long time. And not only are we seeing, obviously, movements within our own country, but now they're talking in Mexico, the possibility of legalization, and throughout Latin America. And that's an area that historically has been, very hostile to this sort of thing. So it's definitely a huge trend people ought to get in on. The other things I like are defense stocks. For some reason, there's this belief that the Biden administration and the Democrats in general are going to be hostile towards defense companies, and it's held back a lot of them. And I think there's a lot of them that are very undervalued here. And there's other ones that are tech plays that aren't really valued as tech plays. So that's another area I would be looking at. Like Northrop Grumman is one that's just a big, safe company, historically undervalued right now. And another one that I really like here is, if you believe in inflation, as Adam was saying earlier, that's part of what's coming, then we're going to see it in materials prices. We already see it. And things like 3D printing, additive manufacturing, any of the stocks in that sector are ones that they've already been moving higher. 3D Systems is like tripled or quadrupled in the last 3 months. It's probably overvalued here since I did my last video on it. But that whole sector is one that you want to start looking at and getting into now, or buy it on weakness, because that's another area that's going to see a lot more emphasis as this awareness of inflation in our economy begins to sort of wake up.
Right. Okay. And Adam, do you have sentiment towards the cannabis space and or other industries that are perhaps being overlooked presently?
Yeah, I think overlooked. So that's a very good question. Yeah, I would echo everyone else's comments. There's no question money is flowing into cannabis stocks. There's no question money's flowing into several of the other areas that we just mentioned. As far as other plays or other ways to play it, I would look for emerging areas. If we get back to this back to normal environment, I know that many parts of the world are still locked down. I know that this new variant of COVID is still raging. But the good news, the one glimmer of hope, is that we do have the vaccine. It is being rolled out. Yes, could it have been done better? Coulda, woulda, shoulda. But there is a path forward where we get back to normal. And then as we get more clarity with respect to getting back to normal with the time frame and what it actually looks like, if it'll be really back to normal or some kind of hybrid or quasi-normal or new normal, who knows? But I think a lot of the stocks in the market that have been left for dead, that's a lot of the retail stocks, the travel stocks, so on and so forth, are going to come back to life in a very big way. And we're starting to see that in a few stocks that have really just had a huge move while almost nobody's looking over the last 3 to 6 months.
Mm-hmm. Okay. Great. Well, then, so, looking at the price of energy and energy stocks, traditional energy stocks, and looking at some of the, I think that there's a sense that the lockdowns and the distancing, people are growing tired of it in places like Sweden and in Austria. People have whole towns have just abandoned any precautions whatsoever. And so I'm wondering, are we possibly moving into a world where it's just like we have resigned ourselves that the coronavirus is going to rampage through the population? it is targeting a demographic that is not representative of the majority. And so we're more sort of coming to grips with the idea that the preventative measures have a more destructive effect on economy and mental health than the preventative measures do on preventing the virus from spreading, which just doesn't seem to be working. So is that why energy stocks are rising? And this is my roundabout way of saying maybe now's the time to get back into travel and airline stocks because this is the world we're moving into. Jeff Z, I'm going to start with you on that question again.
I think that there's so much of the population that's resigned to the fact that they're terrified of this disease. They're terrified, and they haven't made peace with the idea and the reality that it's not going to be eradicated fully, even with vaccines. There's going to be some sort of degree of COVID in all of our lives for the coming years. And so what we don't know is what percentage of the population can tolerate any risk at all. And it seems to me that there's a lot of people that have completely altered their behavior, and we're holding out hope that if you wear a mask, it's going to go away. And that's proven to not be the case. Even in places with hardcore draconian measures, it's still around. People are still getting affected. Vaccines out, not being distributed properly enough. And a lot of people aren't taking it. So what portion of the population creates an impact for the long-term viability of those businesses? I don't know, but there is a tipping point, and there will be winners and losers within the space. But I think you have to do your homework, do your due diligence, and figure out which companies are the most vulnerable, which companies are, the ones that are going to be caught without a chair, so to speak, with this music when the music stops. I mean, the music stopped, but what I'm saying is maybe you don't need 7 cruise lines. Maybe if you're an airline that has already too robust a threshold and you have too many planes that you need to fill to make your business work, I don't know. I don't like to be in business with the government also. So when they're major shareholder of companies, which is my problem with airlines in general, the way it's looking with the bailouts, et cetera, I don't want to be partners with those people. I don't want to be partners because they're going to put a limit on how much you can make, which for me is never a good thing. There was a deep value opportunity, and guys like Jeff Y and Roger, everybody, Adam here, you guys pointed it out. But unless you're in a deep value situation, that's my viewpoint on it.
Mm-hmm. Okay, great. Roger, do you have that sort of approach to the whole idea of the coronavirus and its effect on the economy? Are we in a position where we can sort of start to consider looking at the travel stocks, cruise ships, airlines again, hotels?
Let me answer your question in a multi-layered. I'll address the COVID, I'll address the energy sector, and I'll address the economy all at one time. As far as the COVID, and how different places have reacted to it and what the outcome has been, all you've got to do is look at California and Florida. You have the polar opposite of how 2 states have dealt with it. Meanwhile, I can't say that Florida's thriving, but it's doing a lot better than California, and California has been under a draconian lockdown, and it hasn't really helped much. So has these draconian rules really helped? Not really. Not from so that's how I think about that. All you have to do is look at how at California and Florida, and you will get a very clear answer of what is reasonable and what is not reasonable, and how the 2 states have dealt with it and the outcome. One state had draconian rules, one had very reasonable rules. The one that had very reasonable rules has less infections, better commerce, and actually businesses that are not going to be closed down for the next 20 years. Whereas California tried to take draconian route. They've got more infections and they've got a worse economy. So a complete lockdown is not necessarily the best way to deal with it. There's a smarter way to deal with it. That's number one. In terms of the energy companies, I'm not so sure that the energy companies will be coming back the same, roaring back, the traditional energy companies, and I'll tell you why. first of all, before the COVID reared its ugly head, we still had a huge supply demand issue with traditional energy, and that hasn't really gone away. All right. Number two, a lot of the companies that did take a major spike during the COVID pandemic crucial period, that window period between March, April, and May, those stock like Clorox, Zoom, the toilet paper companies, those stocks are all trading below the 200-day moving average. So we are no longer pricing in a crisis mode in the market, which means we are at some point looking at going back to normality. And with that in mind, if you look at traditional energy stocks, they are nowhere near a breakout level right now. So what that tells me is that the markets are already looking past COVID in certain places, and traditional energy is not one of those places, because the stocks are not where they should be, in my opinion, based on technical levels to say they have shrugged off the COVID environment. So three things. Yes, I think that draconian measurements are not helping the situation. B, I believe markets are efficient enough to no longer be in a panic stage. Evidence of that, most 95% of stocks that were rallying during the crucial window periods are no longer there. And traditional energy has still not overcame very important price levels that would put it in a momentum bullish phase. And you still have the supply demand factors that have no real major association with COVID-19 as it stands right now. I know I took kind of a round way, but I think I answered all three parts of that question.
Sure. Okay, Jeff Yasteen, I'm going to sort of throw the same question package at you. What's your take on all of that?
Like Jeff was saying earlier, the idea of cruise lines and airlines as deep value ideas, was there, the second half of last year, August through November. And I did a video sometime late October, early November, basically saying I thought that the cruise stocks had basically made the majority of their move, and it was time to leave that area. And the thing I would be looking for the cruise stock specifically is that, we really need to see, like for Carnival, to move above $25, which is the same level it hit in June, and then it hit it again in late last year. And so until they start making new highs there, I just would expect that it may continue to just drift lower, waiting for that catalyst, which is somewhere down the line. And maybe it arrives sooner rather than later, but those are ones that I think are just going to continue to drift lower until the market in its wisdom sees an opening there for them to move higher. Same thing for the airline stocks like American Airlines. I'd be looking at that one. It hit a peak of 21 back in June, and I wouldn't buy it until it got back over that level. Let it make a new high, and that's your first inclination to see that there might be something there. It's either that or, again, I think those are going to probably drift lower. Overall, I think that energy stocks are still a buy here. I think there's just, and Roger's expressed a really good skepticism on these. And I don't know, there's an instinct for me to think that the skepticism that so much of the Wall Street community has about these probably is one reason why they're going to continue to move higher. They're not going to get like a higher PE multiple attached to them. They're not growth stocks. They're more like tobacco stocks were, 20, 30 years ago, where everybody thought they were going to die. And, they cut costs, they do what they have to continue to live. And I think the major oil stocks, and we still consume oil in various quantities, plastics, chemicals, et cetera. And so that's going to provide an underlying demand there. And that as the rest of the world comes out of this, this pandemic, and that is going to happen sooner or later, you're going to see the price of oil continue to march higher. again, not a rocket shot, all the way to $100, but I just expect that it will continue to support this level and higher in coming quarters.
Sure. Okay, Adam, reconcile all of this dialogue with your thinking and give us a sort of summary of the takeaway for the week for our audience.
Sure. I'm reminded of a Robert Frost poem, The Road Not Taken, when he says you can only get past it by going through it. And that's what rings in my mind as I hear this COVID situation. Roger's right on the money. You don't go, you can't lock down the world and expect COVID to go away. We've tried that. It doesn't work. So there's got to be some kind of just semblance of common sense, if you will. I know common sense is not so common, but we want to have some kind of just step back for a second and just let's let people decide what's best for them and have a situation where we can get through it. We have to pass through it, like Roger Frost talked about in the poem. So we're going to get through this. It's a fact. It's a matter of when, not if. It's a big disruption. It's an inconvenience. Like you said, James, people are fed up with it, so on and so forth. No question. But the market is always a forward-looking mechanism. In the short term, I want to emphasize caution. We are extremely overbought or extended. I am expecting a pullback of some sort to happen in the short term. Intermediate, long term, the trends are still very, very strong. What Jeff had mentioned earlier about Janet Yellen being a front and center. Obviously, for me, that's the elephant in the room, the proverbial elephant that is. And you want to see what stimulus is going to happen. We're expecting a lot more stimulus from a Democratic, controlled government, but we don't know what that looks like. Are we going to raise taxes on the rich? Are we not going to raise taxes? Are we going to have more stimulus come out? The $600 checks, I'm hearing a lot of people didn't even get them. Now they're going to get another $1,400 on top of that, but then it'll be a treasury type mail-in rebate. There's a lot of just questions with respect to what's going to happen. Are we all going to lock down again, like many other parts of the country or parts of the world, excuse me, or. So we're going to get through this. I'm optimistic, intermediate and longer term. Short term, we are very extended. So just be very careful when you pick your spots and where you invest your money. Understand there's risk and there's reward. So ask yourself, am I early in this cycle or am I late, whatever stock you're buying? And if you're late, then probably exercise a little patience, like Jeff Y had mentioned, wait for weakness, buy on weakness. And like Jeff Z and Roger both mentioned, there are a lot of areas where there's a lot of money to be made for savvy investors.
That's a fantastic conversation, gentlemen. Intriguing times we live in. Indeed, we're going to leave it there for now and come back to you individually throughout the week. Thank you all for joining me today. And thank you, audience. Hope we helped.